In late February 2022, only days after the conflict between Russia and Ukraine began, the United States and the European Union announced a financial action that altered the global system in ways few expected. They declared that major Russian banks would no longer be able to use SWIFT, the worldwide messaging network that links more than 10,000 financial institutions across almost every country. SWIFT itself does not hold funds or move money. It simply sends secure instructions that tell banks how to settle international transfers. Yet, because it processes many trillions of dollars in global payment messages every day, exclusion from the system acts like a modern form of economic isolation. This move was widely described by Western leaders as a financial strike so severe it would break the Russian economy. The ruble was expected to fall without end, major institutions were expected to fail, and the Russian state was expected to face both internal and external pressure strong enough to force a retreat. Instead, something else happened. Not immediately, but steadily. Russia stabilized its currency through aggressive interest rate moves, and by requiring payment for key exports in its own currency. Russian trade slowed during the initial shock, but soon rerouted through channels outside Western systems. Major buyers in Asia and the Middle East continued purchasing energy and other goods, paying in currencies other than the dollar when needed. Rather than collapsing, Russia adapted to life without the Western-dominated network. This created a new concern for many countries. If one large nation could be disconnected from the global messaging system for political reasons, then others could face the same risk in the future. The question was no longer about supporting or opposing Russia. It was about whether any state could trust a system in which access depended on geopolitical alignment. The decision to cut off Russia did not occur in a vacuum. It was part of a long history in which dominant powers used financial tools as instruments of pressure. Over the past century, this pattern appeared repeatedly. The strongest financial power used its position to punish rivals. Those rivals then built alternatives. Neutral countries saw the danger and spread their reserves across several systems to avoid dependence on one dominant player. Eventually, the leverage that once seemed overwhelming lost its force as more nations created their own channels for payments, reserves, and trade. This dynamic unfolded with Britain during the early 20th century, and with the United States during the late 20th and early 21st centuries. Each case showed that the act of weaponizing financial infrastructure provides short-term advantage, but long-term decline in influence. By 2022, the United States controlled the main arteries of global finance. But by using this control against a major state, it repeated the pattern that once weakened those who held the same power. To understand why the financial action against Russia had such deep global consequences, you need to understand what SWIFT actually does, and why it became indispensable. SWIFT is not a bank, and it does not hold deposits. It is simply a standardized messaging framework that allows banks in different countries to communicate securely about cross-border transactions. Before its creation in the early 1970s, international payments relied on older systems that were slow and error-prone. SWIFT provided a reliable structure that reduced mistakes and accelerated settlement speeds. Over time, it became the standard language of global finance. Tens of millions of payment instructions move across the network daily. Even though money itself flows through separate correspondent banking relationships, the SWIFT message is what activates and verifies those transfers. What gives the system its unique power is its governance. SWIFT is headquartered in Europe and presents itself as politically neutral. However, most of its influence comes from the fact that the majority of global settlements clear through dollar-based banks in the United States. This means that even without direct ownership, the United States can influence the network through its control of the dollar clearing infrastructure. Banks everywhere need access to New York correspondent banks if they want to participate in global commerce. As long as the world depended on dollar-based settlement, the United States had the ability to pressure the SWIFT network into excluding specific institutions. The use of such authority was not new. More than a decade earlier, the United States pushed the network to disconnect several Iranian banks. That decision significantly harmed Iran's economy and forced it to search for new ways to conduct trade. But Iran at the time represented a small fraction of global commerce and lacked strong alternative partners. When Russian banks faced the same action in 2022, the situation was entirely different. Russia was a large exporter of energy and raw materials and had long-standing trade relationships across Asia, the Middle East, and parts of Europe. More importantly, Russia had already spent years building fallback systems, because after earlier sanctions in 2014, it learned that access to Western networks could vanish without warning. When the cutoff occurred, Russia activated its domestic messaging system, strengthened connections to non-Western payment networks, and expanded the use of regional currencies for trade with key partners. These adaptations did not erase the economic shock, but they prevented total collapse. Meanwhile, other nations observed the event with growing concern. If such a large country could have its reserves frozen and its banking system disconnected through decisions made in foreign capitals, then any country not aligned with those powers faced similar vulnerability. Even states friendly to the United States recognized that relying entirely on a single global system created national-level risk. This realization triggered a shift that continues to shape global finance today. The reaction to the 2022 cutoff revived an older pattern that had appeared several times during the last century. Financial dominance always seems invincible until it is used as a weapon. Once that happens, the foundation begins to weaken. The first major example came during the early stages of the First World War. At the time, Britain was the center of global finance. The British pound served as the primary reserve currency, and banks across continents relied on London for settlement and credit. When war broke out, Britain passed laws that allowed it to freeze and seize assets belonging to citizens and companies of the opposing side. For generations, financial dealings had been treated as separate from military conflict. Even during earlier wars, banks still honored contracts to maintain trust in the global system. Britain broke that long-standing tradition by turning financial infrastructure into an extension of wartime policy. This decision harmed German companies immediately. They lost access to their assets stored within British territories and found themselves cut off from international markets dominated by London. But the long-term impact was felt not in Germany but in neutral countries. Leaders in those nations realized that their wealth held in London could be taken if Britain ever judged their political position unacceptable. To protect themselves, they began moving reserves to the United States and other emerging financial centers. That shift marked the beginning of London's gradual decline as the world's financial core. By the middle of the 20th century, the dollar had replaced the pound as the main reserve currency, a transition accelerated by war damage and economic strain. A similar pattern appeared decades later when the United States froze Iranian assets in the late 1970s after the hostage crisis. The action achieved immediate goals, but also warned many nations, especially in the Middle East, that dollar reserves stored in New York were not entirely safe. Over time, these countries diversified their holdings into other currencies, gold and accounts in Europe and Asia. This diversification slowed the growth of dollar share in global reserves and demonstrated again that using financial power as a tool of coercion often weakens the very system that provides that power. In the case of Russia, the situation evolved over two distinct phases. The first occurred in 2014, after the annexation of Crimea. The United States imposed targeted sanctions, but stopped short of severing Russia from the global messaging network. That decision unintentionally offered Russia valuable time. For 8 years, Russia reduced its exposure to dollar-based systems, increased its gold reserves, built its own domestic payment messaging platform, and strengthened commercial ties with nations that were either neutral or sympathetic. When the more severe measures arrived in 2022, Russia was not fully prepared, but far more insulated than most analysts assumed. The sanctions did slow growth and cause disruption, yet they also confirmed to Russia that its efforts to diversify had been necessary. Countries observing these events concluded that depending too heavily on a single financial structure created long-term geopolitical and economic risk. By the time the 2022 measures took effect, Russia had already built the outlines of an alternative system. It expanded its domestic financial messaging network and strengthened links with similar platforms in Asia. China operated its own cross-border payment messaging system, which grew rapidly as Russian institutions joined and used it for both commercial and banking transactions. These systems were not as large or as mature as the Western-dominated network, but they were sufficient to keep trade flowing with countries willing to continue economic ties. Russia also relied on local currencies for transactions with major partners. Energy sales to China and India, for example, were increasingly priced in yuan, rubles, or rupees. This shift signaled that even a large economy under heavy sanctions could remain functional by adjusting to regional systems and alternative settlement options. What truly reshaped global finance, however, was not Russia's response, but the reaction of countries that were not directly targeted. Many governments that maintained stable relations with the United States and Europe began reassessing their financial structures. They recognized that reserves held in Western banks were vulnerable to sudden restrictions. Even nations long considered close allies looked for ways to protect their assets without openly challenging existing alliances. They increased gold reserves, opened accounts in Asian financial centers, and developed regional payment systems designed to bypass heavy reliance on the dollar. Several large economies accelerated efforts to trade in their own currencies. China already promoted the international use of the yuan. The events of 2022 gave this initiative new momentum. More countries agreed to settle energy, minerals, and manufactured goods in yuan or in local currency pairs. India expanded similar arrangements with key partners and grew the use of its own digital payment architecture for cross-border trade. Middle Eastern states with deep energy exports explored non-dollar settlement options as a complement rather than a replacement. Still, these shifts indicated growing awareness that a single dominant currency created concentrated risk. Another development involved multinational groups forming new economic partnerships. Regional alliances discussed shared settlement systems, local currency swap lines, and partial alternatives to dollar-based trade. Some of these proposals remained in early stages, but their collective direction showed that nations were preparing for a more multipolar financial world. None of this immediately displaced the dollar or the Western systems. But each decision, whether driven by caution or strategic planning, reduced the global dependence that once allowed the system to operate with unrivaled authority. The weaponization of financial tools did not instantly break the dominant structure, yet it encouraged a growing number of states to diversify away from it, quietly but consistently. As more nations explored alternatives, the limitations of using financial infrastructure as a strategic tool became clearer. The dominant system still handled the majority of global payment messaging, but its influence no longer appeared absolute. SWIFT message volume continued to grow in total numbers, yet its share of worldwide financial communication began to shrink as other networks expanded. China's cross-border payment platform increased its traffic sharply within a short period, linking banks across many countries and processing transactions in yuan. Russia's domestic messaging network became widely used within its own borders and maintained links with foreign institutions that chose to engage with it. India's digital payment network also expanded and slowly moved from a domestic success story to an emerging cross-border tool. None of these platforms matched the scale of the Western network, yet together, they represented a meaningful shift in global financial behavior. Central banks responded to these developments by adjusting their reserve compositions. Many increased their gold holdings, in some cases reaching levels not seen for decades. Gold appealed to states seeking an asset immune from external political pressure. Unlike foreign currency reserves held in another country's banking system, gold stored within a nation's own borders could not be frozen by external authority. This trend aligned with the broader movement toward diversification. Instead of keeping the majority of reserves in dollars, states spread their assets across multiple currencies, sovereign bonds from different regions, and commodities including gold. Beyond reserves, trade itself began to take new forms. Large energy exporters experimented with non-dollar settlement methods. Some accepted yuan for oil sales to Asian buyers. Others used local currency swaps that allowed direct exchange without passing through the dollar system. These arrangements were small relative to total global trade, but their growth demonstrated a willingness to test new financial pathways. As these smaller channels matured, countries grew more comfortable using them for a larger share of their transactions. Regional coalitions also played a role. Groups representing developing economies discussed shared financial structures designed to reduce reliance on Western institutions. Some proposed common settlement currencies backed by baskets of commodities. Others focused on enhancing connections among regional banks to improve trade flows without needing the dominant currency for every exchange. These efforts remained early stage but signaled a long-term strategy. The more countries participated in such arrangements, the more the global financial landscape shifted toward a multipolar design. The still dominant system retained clear advantages, such as broad adoption, legal familiarity, and the liquidity of its currency. Yet, every diversification step by other nations slightly reduced the leverage it once enjoyed. Financial power built on trust and stability now appeared more fragile than many realized. The cutoff in 2022 did not break the system, but it accelerated trends that had already begun, pushing the world closer to a diversified and less centralized financial environment. The multistage pattern seen throughout financial history helps explain why the actions of powerful states often generate results opposite to what they intended. The first phase arises when one country reaches a position where its currency and banking system dominate international trade. This dominance usually stems from economic strength, political stability, and global trust built over many years. The second phase begins when that same country uses its financial system to influence or punish another state. At first, this seems effective because of the depth of its control, but once the financial system becomes a strategic tool rather than a neutral infrastructure, the affected states begin developing alternatives. This marks the third phase. Even if alternatives are small, they represent the first cracks in the system's monopoly. The fourth phase follows when unrelated nations, especially those that value autonomy, start hedging. They do not necessarily oppose the dominant power, but they realize the risks of having all their reserves and settlement channels flowing through one authority. Hedging can take many forms. It may involve holding more gold, building bilateral trade corridors, or signing currency swap agreements that allow direct settlement without relying on a single global currency. Over time, these hedging strategies erode the influence of the once dominant player. The fifth phase arrives when the original system still exists but no longer holds unquestioned power. Its tools become less effective because the world prepares for them in advance. By 2022, the global financial environment had clearly entered this multi-phase cycle. Nations not involved in the conflict reassessed their exposure to Western financial leverage. Some large economies reduced their holdings of Western government bonds. Others created digital payment systems that could operate independently. Regional partners arranged currency swap lines to settle cross-border trade without passing through the dollar. Energy exporters explored new pricing and settlement options. These steps did not amount to full abandonment of the established system, but they created buffers that limited vulnerability. Several countries with significant economic influence played central roles in these changes. China continued expanding the use of its currency in international trade and invested in payment infrastructure capable of handling global volume. India strengthened its economic partnerships, using local currencies in a growing share of transactions. Gulf states diversified their financial relationships, opening channels with Asian and African partners. Latin American and African regions explored collective settlement platforms to reduce reliance on dominant currencies. These collective actions signaled that global finance was evolving from a structure centered around one dominant currency to a more distributed network with several major nodes. Even if the established system remained the largest, the rise of parallel structures meant its influence could no longer be taken for granted. The shift was gradual but steady, driven not by hostility but by pragmatic risk management as countries sought financial systems that could withstand geopolitical shocks. As nations rebalanced their financial exposures, the practical effects on global markets began to surface. The dominant currency still accounted for the largest share of global reserves, but its proportions steadily declined. 2 decades earlier, it made up more than 2/3 of worldwide reserves. Over time, that share dropped as states sought safer and more diversified portfolios. Many governments acquired large amounts of gold because it could not be restricted by external authorities. Gold purchases reached levels not seen in many decades, showing a clear shift in how central banks viewed risk. Some nations increased holdings of other major currencies, while others added regional currencies tied to key trading partners. Trade settlement patterns also changed. Fewer transactions automatically used the dominant currency. More trade partners chose to settle in local currencies, or in currencies preferred within their region. China and Russia increased their bilateral trade and settled much of it in yuan and rubles. India purchased energy from various suppliers and sometimes used rupees for settlement. Middle Eastern exporters accepted alternative currencies from countries that represented major buyers. These decisions were practical rather than ideological. Trading in local or regional currencies reduced cost, simplified exchange processes, and lowered exposure to sanctions risk. Parallel to these developments, new financial messaging systems grew rapidly. China's cross-border platform reached hundreds of participating institutions. Russia's messaging network handled substantial volumes domestically and connected internationally where possible. India explored expanding its digital payment platform beyond its borders. Several African and Asian regions discussed building shared messaging or settlement systems suited to their economic needs. None of these replaced the existing dominant network, but they created redundancy. Redundancy is a safeguard that weakens the central authority's ability to impose consequences through exclusion. Commodity markets also experienced adjustments. Large purchasing nations began negotiating long-term contracts priced in alternative currencies. Some suppliers agreed to transact in yuan or in baskets of currencies rather than relying solely on the dollar. This shift did not overturn global pricing structures overnight, but positioned these markets for gradual diversification. Once a few major players accepted new settlement terms, others followed, reducing reliance on any single reserve currency. The increase in local currency trade, the growth of alternative payment networks, and the heightened demand for gold all pointed toward the same trend. Nations were preparing for a world in which financial power was more balanced and less centralized. The established system still had clear advantages due to its liquidity, scale, and long history. Yet each incremental choice by governments, whether to use a regional currency or adopt an alternative network, contributed to the long-term movement away from singular dependence on the dominant currency. The transformation was not abrupt, but instead a slow buildup of changes that reshaped the structure of global finance. As the global system adjusted, one question dominated discussions among economists and policymakers. How long would it take before the dominant reserve currency lost enough influence to mark a clear transition to a multipolar structure? The answer required examining patterns from earlier eras. When Britain controlled global finance in the early 20th century, it took several decades for the pound to lose its reserve status. The decline accelerated due to two world wars, financial strain, and the rise of the United States as an economic powerhouse. Although Britain still mattered, the dollar became the preferred reserve currency long before the transition was formally recognized. In the present era, the circumstances differed. The United States remained economically strong, technologically advanced, and deeply integrated into global trade. Yet the financial action taken in 2022 acted as a spark that encouraged nations to accelerate diversification plans already underway. Unlike a century earlier, modern technology enabled new payment networks to scale rapidly. China's cross-border platform expanded across dozens of countries in a short period. India's digital infrastructure processed billions of domestic transactions each month and prepared to handle more international volume. Russia continued strengthening its internal systems. Regional groups in Asia, Africa, and South America explored joint currency arrangements or shared settlement systems. Alternatives that once would have taken decades to grow could now reach critical mass in only a few years. Estimating the timeline for change involved observing the speed at which reserves diversified and the pace at which trade settled in non-dollar currencies. Reserves held in dollars decreased gradually for many years, but began falling more quickly after 2022. Energy exporters moved portions of their reserves into gold and into currencies associated with their primary customers. Large Asian buyers signed contracts allowing settlement in regional currencies. Some European partners explored diversification as well to reduce vulnerability to external shocks. These shifts did not imply a complete abandonment of the dollar, but indicated that its uncontested dominance was fading. Another factor was the growth of bilateral currency agreements. Many nations entered arrangements that permitted direct currency exchange without relying on a single intermediary currency. China signed numerous agreements across Asia, the Middle East, and Latin America. India expanded swap lines with trading partners. Russia negotiated direct settlement channels with key allies. Such agreements reduced the need to use the dollar for every cross-border transaction, lowering trust in the idea that one currency must remain central to all trade. The emerging timeline suggested that while the dollar would remain important for many years, its role as the overwhelmingly dominant reserve currency had begun to shift. The world moved cautiously, but consistently toward a more balanced financial environment, supported by technology, diversification, and lessons learned from recent geopolitical events. The implications of a shifting reserve structure extended far beyond currency charts or central bank balance sheets. They influenced national budgets, trade flows, investment patterns, and the daily reality of households around the world. For decades, the United States benefited from the unique position of issuing the main global reserve currency. This role allowed the country to borrow at low cost, run large deficits, and import far more than it exported. Foreign governments held vast amounts of dollar-denominated assets since they needed them for trade and financial stability. This demand kept interest rates low and supported the American standard of living. As more nations diversified their reserves, the long-term picture began to change. If the share of reserves held in dollars continued to decline, demand for United States government bonds would eventually weaken. Lower demand would mean higher borrowing costs. Higher borrowing costs could make large budget deficits increasingly difficult to sustain. The United States would still be a major economy, but its ability to finance expansive domestic and global commitments without financial pressure might decline. None of this would occur suddenly. Instead, it would unfold as a gradual adjustment, influenced by shifts in global preference and the pace of diversification. Other countries would feel the changes as well. Nations that relied heavily on dollar-priced imports could experience higher costs if exchange rates shifted unfavorably. Countries that exported commodities priced in other currencies might gain more bargaining power. Regions with strong bilateral currency agreements could enjoy greater resilience during global financial disruption. These changes would create a world where no single currency dictated global trade. Instead, several major currencies would operate side by side, each with regional or sector-specific influence. Winners and losers would emerge based on how well nations adapted. China appeared positioned to benefit from expanded use of its currency and trade. Its payment systems grew quickly, and it cultivated major partnerships with states seeking alternatives to Western-dominated networks. India gained leverage by conducting more trade in rupees, and by expanding its digital financial architecture. Russia strengthened its position in certain markets by demonstrating that it could withstand exclusion from the dominant messaging system. Middle Eastern energy exporters gained new flexibility by accepting multiple currencies for oil and gas. At the same time, certain actors faced challenges. Institutions tied exclusively to the dominant network risked losing influence as alternative systems expanded. Countries holding large amounts of dollar-denominated debt could confront higher refinancing costs. Economies dependent on low-cost imports might feel pressure if the dollar gradually weakened. The global landscape would not collapse, but rather shift into a more complex arrangement in which economic power was distributed across several nodes instead of concentrated in one way. As the global financial environment continued to evolve, one conclusion became clear. The events of 2022 marked a defining moment in the history of international finance. When a powerful nation uses its financial system as an instrument of punishment, it might achieve short-term objectives, but it also signals to the rest of the world that access to that system is conditional. Once that signal is sent, countries begin preparing for the possibility that they could one day face similar restrictions. They build fallback networks, accumulate assets that cannot be frozen, connect with regional partners, and strengthen ties with economies that operate outside the dominant framework. Over time, these actions reshaped the global order. The dominant system did not collapse when it was used as a weapon. Instead, it initiated a slow process of erosion. Each country that created an alternative trade channel, established a regional payment network, or diversified reserves contributed to the gradual weakening of a once unchallenged structure. The world did not abandon the dollar or the primary messaging network overnight, yet the reliance that once defined global finance began to loosen. The forces driving this shift were not based on hostility, but on risk management and caution. Nations simply recognized that depending entirely on one financial center exposed them to decisions made far beyond their borders. The transition toward a multipolar financial world did not eliminate the influence of the United States. The country remained a major economic and technological power. Its currency continued to be widely held. Its financial markets stayed deep and liquid. But the era of unchallenged dominance started to fade as alternatives matured. China strengthened its position with widespread use of its payment systems and currency agreements. India expanded its influence with a growing digital financial infrastructure. Regional alliances developed shared economic tools that reduced dependence on any single global authority. These developments collectively signaled a new phase in global finance. In this emerging world, nations acted with greater autonomy. They structured trade agreements in local currencies, diversified their reserves, and aligned with multiple economic partners instead of depending on one key. The dominant system remained important but no longer held exclusive control. Its tools, once viewed as decisive, lost impact as more countries shielded themselves from potential restrictions. The lesson learned across continents was straightforward. A financial weapon can only be used effectively once. After that, the world adapts to make sure it cannot be used again with the same force. Looking back, future historians would likely identify the decision of 2022 as the moment the global financial hierarchy began to transform. Not through abrupt collapse, but through steady diversification. Not through conflict, but through practical adjustments. The world did not reject the existing system. It simply prepared alternatives. And through those alternatives, a new distributed and resilient global financial structure emerged, closing the era of singular financial dominance and opening a more balanced chapter in international economic history.